Hi, I'm Josh Gottfried, co-founder and partner at Gottfried and Sommer Wealth Management. Each quarter, we discuss interest rates to learn a little bit about what we can see from the yield curve, both in the economy going forward as well as investments. And there's been a change in the posture of the Federal Reserve over these past 3 months. They had been easing interest rates over the past year, and all of a sudden we saw that really come to a halt when they decided that they wanted to have a more stable interest rate environment going forward. And after they made that decision, we saw that unemployment numbers came in and they were really good. And in fact, the number of jobs created last month was almost twice what they had expected at almost 250,000. In addition, we've seen concern about inflation coming back. We had inflation all the way up in the 8% range a couple of years ago. That has come down into the twos and into the threes. The Fed would really like that to be in the 2 to 2.5% range. And the past month producer price index that just came in was over 3%, which again leads there to be a little bit of concern there. And we've seen that in the stock market. After the election, we saw the stock market rally pretty significantly. Then by the middle of December, we saw it start to fall a little bit. And we saw some weakness the last couple of weeks of December. And at this point now, the US stock market's about 5% below where it was at its peak just a couple weeks ago. So let's go into the chart of the yield curve, and let's take a look at what that'll show us. When we look at the yield curve, remember that the y-axis shows interest rates between 3.4 and 5%. And the x-axis shows maturity from 6 months on the left-hand side all the way out to 30 years on the right-hand side. The blue line shows the yield curve effective September 30th, and then this red line is what it was at the end of the year. So if we start on the blue curve, what we'll see is that this first 1 month number is around 4.9%. And that's where we were back in September. Now, as we move forward on these yield curves, we're not as interested in interest rates as we are in what the forward rate is. Now, you can look back to a previous video that'll go through the derivation of forward rates, and I'll show you how to calculate them. But for our purposes, forward rates, if we think about a 4-month yield as a blend of a 1 month yield plus the second month, the third month, and then the fourth month. So the average of that is around 4.6%. But what the interest rate actually is in that fourth month is 4.4%, which is able to bring it down from that 4.9 down to that 4.6. And again, as I talk forward with this, we're going to talk just about what those rates are moving. And you can see that, that's a pretty steep decrease in the curve. We see it even steeper as we go through the 6 month drops all the way down to 3.8%. 1 year goes all the way down to 3.6%. And then it ends in here around 3.3%, and that's about the terminal, the farthest it goes down. And that's what we saw 3 months ago. If we take a look at the red line is what interest rates were effective the end of the year. And you can see that's basically flat, and then it starts to go up at the end, which we'll talk about that as well. The basically flat line starts at around 4.4 because interest rates had already fallen. But the expectation is interest rates are not going to fall a lot more. So it only goes to 4.2% here, down to about 4.1% here, and then starts to work its way back up. So it's around 4.5% by the time we get back up to 5 years again. And you can start to see that increasing slope, which is a much more normal interest rate curve that you're used to seeing versus these inverted curves that we've seen for the past couple of years. So what does this tell us about the future? Well, what it tells us pretty straightforward is that if we think back to September, the expectations were the Fed was going to continue to cut rates, probably aggressively. It wasn't just going to cut them for a couple of months, but probably for a couple of years. We were going to see some, really significant decreases in interest rates across the board. If we think about what we see now, we see something very different. We see basically a benign, stable interest rate environment where interest rates are not going to decrease a whole lot over these next 3 to 6 months. But we see something over here, which is really different. What we see over here is on the long end of the curve, those 20-year, those 30-year pieces. On those, what we end up seeing is we see something where all of a sudden interest rates now are a percentage point higher than they were. And if interest rates are a percentage higher than where they were, that means that things that are impacted by those long-term interest rates, like mortgages, are also higher. And we see that across the board. Back in September, we saw mortgage rates in the low sixes. Now they're hovering pretty close to 7%. And the other piece that we see as we look forward on this interest rate curve is the expectations of the economy are a lot stronger. This idea that they thought that the economy was going to go down, that we were going to see interest rates really fall, is one now where all of a sudden maybe we are at this soft landing place where going forward, we're able to have a strong economy, good unemployment, good jobs numbers, as well as relatively low inflation. If you have questions about this or any of the other pieces we put together, please let us know. We look forward to doing this